Understanding Risk versus Reward, Newbie Investor Edition. Investing sounds exciting, right? The idea of making money while you sleep? Amazing. But then you hear stories of people losing everything, and suddenly it feels risky. So, should you be scared? Or is risk actually the key to growing your money? Let's break it down in just 5 minutes. What is risk? Risk in investing simply means the chance of losing money. The higher the risk, the higher the potential reward, but also the greater the chance of losses. Think of it like flipping a coin. If I told you every time you get heads, you win $10, but every time you get tails, you lose $10, would you play? Probably, because the stakes are low. But what if I changed it to $100 or $1,000? Suddenly, the risk feels a lot bigger, right? This is exactly how investing works. The bigger the potential gains, the bigger the potential losses. Now here's the twist. You can control your risk. Smart investors don't just gamble. They make strategic choices to balance risk and reward. Different levels of risk. Not all investments are equally risky. Let's break them down into 3 levels. 1. Low risk, savings accounts, fixed deposits, and bonds. These are the safest options, but the returns are low, usually just enough to keep up with inflation. 2. Medium risk, ETFs, index funds, and blue-chip stocks. These offer moderate returns and are great for long-term investing. 3. High risk, individual stocks, crypto, and startups. These can skyrocket or crash overnight. Now, if you're just starting, does this mean you should avoid high-risk investments altogether? Not necessarily. It just means you need a strategy. How to manage risk. Here's the secret. You don't have to take huge risks to grow your money. Smart investors use 3 key strategies to manage risk. 1. Diversification. Ever heard the saying, "Don't put all your eggs in one basket"? This is exactly why investors spread their money across different assets: stocks, bonds, ETFs, and even cash. If one investment fails, others can balance it out. 2. Long-term thinking. The stock market goes up and down every day, but over time it generally trends upward. Panic selling during a dip is one of the biggest mistakes new investors make. Instead, zoom out and think in terms of years, not days. 3. Only invest what you can afford to lose. Investing isn't about gambling your rent money. It's about growing your extra cash over time. Start with small amounts, and as you learn, increase your investments. These 3 simple rules help protect your money while still allowing it to grow. The risk-reward mindset shift. So here's the real mindset shift. Without risk, there's no reward. But that doesn't mean you should take wild risks. It means managing them wisely. Investing isn't about quick riches. It's about building wealth, step by step. Start small, stay consistent, and let time do the work for you. If this video helped, hit that like button and subscribe for more investing tips.